We're talking about the difference between interest-only mortgages and repayment mortgages for investing in property. We're talking about it in the context of today's market, which is in a high inflationary market. So today I have fixed some mortgages. I've fixed 2 buy-to-let mortgages and 1 residential mortgage. Why would somebody do this? Somebody would go to the trouble of fixing mortgages, whether it's interest only or repayment, because they're unsure of what's going to happen in the interest rate environment for the future. And that's where we are at the time of filming. This is December 2021, but we've been in this kind of area of uncertainty for quite a long time now, with people speculating that interest rates are going to go up when the Bank of England meets. And I had some conversations today with a mortgage broker, and he thinks that mortgage rates are going to go up. By the time this video comes out, we'll know if that's true or not. But historically, right now, the lowest they've ever been at 0.1%. This is incredibly low. Now, the other thing that's going on at the moment is there's extremely high inflation. We think that inflation is somewhere between 5 and 10%. The government says at the moment it's about 5%. But when I'm buying things, it feels like it's more 8 to 10%. Things are going up a lot. What does that mean? It means there's a higher probability that the Bank of England, which is in the UK, but other monetary policy committees around the world are going to start thinking about raising interest rates. This is to control inflation and to ease some of those inflationary pressures. What happens with your mortgage? If you're doing property investment as a business, then you want to be thinking about the kind of fixing your costs or managing your costs. And in some cases, when inflation is going up and interest rates may go up, some property investors start to think about balancing their portfolio, really balancing their risk by fixing interest rates. What we've done today is we've fixed 2. Actually 3. I fixed 1 residential and 2 on the investment side, on the buy-to-let side. And in terms of the difference between interest only and repayment, on the interest only side, basically in a high inflationary environment, your debt decreases. That's because everything else in the market goes up. The costs around the world go up for suppliers, for businesses, for individuals. That causes wages to go up. And when wages go up, everything else continues to go up because people can afford to pay more, which means rents go up, etc. And that further encourages banks to increase interest rates. And is it good for investors if banks do increase interest rates? It's not good, it's terrible, because your costs can go up. And if you have a lot of properties, it's not so difficult if you've got 1 or 2. If you've got 5, 10 properties and they're floating on a tracker rate, which means just tracks the market. If interest rates go up, then the cost of your mortgage will go up. You times that by a larger portfolio and your costs could go up significantly. Now, the reason I've gone with the interest only, there's a number of reasons. Number 1, it fixes my risk. I know that I'm going to be paying around 2.5%, which is very low, 2.5% for around 5 years, which I feel very confident about. And I thought it was actually worthwhile making a video. So the reasons I wanted to fix at 2.5, because rates can go down as well as up, and I don't know where they're actually going to go. Nobody does. But the reason I feel confident at 2.5 is because inflation is well above 2.5% at the moment in the UK. I think it's somewhere between 5 and 10%. So we're effectively getting a low-cost mortgage, and inflation is eating away the cost of the mortgage. Meanwhile, we can rent out the other rooms in the property. It's a 3-bedroom house. We're going to turn it into a 5-bedroom property, and that income, we can invest that income. We can invest it in shares. We can invest it in other properties. We can be generating cash flow, which in the future we can pay off these debts on the properties. But actually, in reality, I've also heard that you can refinance an investment property. So you don't really ever have to pay it off. If you've got an investment property and you fixed it for 5 years, in 5 years' time, you can fix it again for 5 years on a 30-year term, which basically means you can keep investing that excess cash in other highly profitable assets, whether it's other properties or shares or other investment types that bring in additional income. So there you go. I think it is quite important to be thinking about these things, and if you haven't at the time of filming, if you're not thinking about fixing mortgages or how much you're paying and balancing risk, it can be something to consider, especially with inflation going up. So no matter what time you're watching this video, whenever inflation starts to rise, that's when central bankers, they become a bit jittery. They don't really know where it's actually going to go. What that means is it might be good for one to consider what properties and where your debt is. If you're at the start of your journey like we are in terms of property, I only have this one house, which is a 5-bedroom house, but I only have this one at the moment. In 3 or 4 months, hopefully it'll be 4 or 5. But anyway, if you have a smaller portfolio, there's a little bit less risk. But as you grow and start taking on more debt, that's when thinking about the difference between interest-only mortgages versus repayment mortgages really comes in, and it becomes almost like portfolio management. There's a lot of investors, property investors, that actually go bust by not managing the risk of interest rates. That you need to make sure that you can manage your costs so that you've got demands, you've got people renting your rooms, and you've got a good solid product. But on the other side, you've got to make sure that you can manage that interest rate risk, which at the moment, at the time of filming, end of 2021, I really think that there's a higher probability of interest rates in 2022, 2023, and the next kind of up to the next 5 years. And that's the reason why I fixed 2 buy-to-let mortgages and a residential mortgage. Not this one, but me and my partner are buying a residential. The property that I'm in at the moment, we fixed on a 5-year last year, which means probably in about 3 months' time, I'll have the 2 resis. I've got this resi with a friend, and I've got my resi with my partner, and then 2 buy-to-let properties, and all 4 will be on 5-year fixed mortgages. 3 of them will be, I think 3 will be repayment and 1 will be interest only. Potentially 2 of the business properties might be on interest only. But either way, the benefit for me is I know exactly what my costs are going to be for 5 years. As I've mentioned, I can invest the difference in other asset classes, and I know where I stand. I don't need to worry too much about what happens in the interest rate markets now, because I've fixed for 5 years. The other thing about fixing is that even if these deals fall through, the offers that I've got are actually valid for 6 months, which means if I buy another property elsewhere, one falls through, I can actually use that mortgage, that offer, that 2.5, about 2.5% for 5 years on another property. When you're in this unique situation where there's low interest rates but there's high inflation, it can be a good idea to get a decision in principle or an agreement in principle or a mortgage offer that's valid for 6 months, because it gives you that added amount of flexibility. As knowledge is power, especially the right kind of knowledge, and of course, progress is everything. And I'll see you guys in the next video.